What if the bank of the future was actually created a decade ago? That's the story behind fintech startup Blend, founded in 2012 with a vision to revolutionize consumer banking. Though its journey has seen highs and lows, Blend built a lending platform now used for over $1 trillion in mortgages. Its strategy is partnering with, not disrupting, big banks. Can this tech innovator transform financial services despite recent struggles? Blend was founded in 2012 by Nima Gamsari, a computer science graduate from Stanford University who previously worked at data analytics firm Palantir Technologies. As a member of the team tasked with deploying Palantir software at big banks following the 2008 financial crisis, Gamsari saw firsthand the antiquated technology infrastructure and paper-based processes still prevalent in the mortgage industry. He realized there was a massive opportunity to modernize lending through cloud-based software. Frustrated by the bureaucratic hurdles of working at an established company like Palantir, the ambitious Gamsari left at age 26 to start his own venture. Along with co-founders Erin Collard, Eugene Marinelli, and Roscoe Hill, he set out to transform consumer lending by building technology to power the mission-critical interface between financial services firms and consumers. The name Blend reflected the founding team's goal to create a better lending experience by blending technology and empathy. Headquartered in San Francisco, the startup set its sights on streamlining the cumbersome mortgage process. Beyond mortgages, the long-term vision was even bolder: to bring simplicity and transparency to all consumer banking so everyone could readily access capital. In its early days, Blend focused on developing an end-to-end digital platform to overhaul mortgage applications and underwriting. This entailed building capabilities ranging from customer identity verification to pulling financial data from various sources to calculating customized rates and managing documents. A key challenge was convincing risk-averse banks to adopt new technology from an unproven startup. The lack of an urgent catalyst prevented early adoption, though its platform demonstrated clear consumer experience and efficiency advantages. The turning point arrived in 2015 when Quicken Loans launched its Rocket Mortgage online lending initiative with a major marketing blitz. Alarmed by the prospect of losing market share, traditional banks overcame their hesitancy and turned to solutions like Blend to digitize their own operations. Major customers like Wells Fargo, US Bank, and First Republic Bank validated Blend's business model, focused on partnering with, rather than disrupting, incumbent participants. This positioned Blend for exponential growth as its software went from facilitating $50 million in mortgages in 2019 to $96 million in 2020, nearly a third of all US mortgages. The same website's analysis shows Blend's platform cuts mortgage closing times by over a week and drives $520 in cost savings per loan, translating to sizable productivity gains for lenders. For example, US Bank achieved a 136% increase in mortgage fee revenue in 2020, with no staff increase because of enhanced efficiency from Blend. Beyond mortgages, Blend is expanding into broader consumer banking services like auto lending, credit cards, and deposit accounts. Its Blend Builder platform employs modular, configurable components so banks can design and test new digitally native products faster. The company hopes this horizontal expansion will provide a counter-cyclical buffer against fluctuations in mortgage volumes. By powering more seamless, automated lending experiences, Blend offers advantages to both banks and their customers. For banks, it provides the agile digital infrastructure to compete with nimble fintech disruptors. Technology, not legacy bureaucracy, becomes the source of competitive advantage. Banks using Blend cut costs through greater process efficiency and staff productivity. Lower operational expenses translate to improved profit margins and the flexibility to pass on some savings to consumers through reduced fees or interest rates. For consumers, this company enables faster, easier access to credit and financial services. Applicants can input information and upload documents conveniently on any device. Blend's intelligent algorithms surface relevant offers and opportunities based on each user's financial profile. Approvals become quick and painless, as automated workflows replace time-intensive manual reviews. By remembering user details, Blend also eliminates the frustrating re-entry of personal information when applying for multiple products from the same institution. With a better customer experience, banks see increased loan volume, lower default rates, and greater customer loyalty. Blend's simplification and standardization of historically complex lending procedures make homeownership more financially achievable for millions of people. Expanding access to credit and banking services through technology aligns closely with Blend's professed mission of promoting financial inclusion. The company estimates its addressable market at over $33 billion, based on consumer lending volumes, revealing ambitious growth plans. Redesigning banking around user-friendly digital experiences helps bring more people into the formal financial system. By lowering the barriers to credit, it empowers underserved groups to become homeowners, vehicle owners, and entrepreneurs. Blend's advances in automating decision-making also increase lending accuracy and fairness. Algorithms consistently apply empirical data, avoiding individual biases that unconsciously influence human decisions. As low and moderate-income households gain equal access to mortgages, the financial security tied to home equity becomes attainable for more communities. However, while this company's technology expands inclusion, its business model centers on selling software to incumbent banks. This means marginalized groups still depend on institutions that may not fully prioritize their financial needs. Blend enables greater access, but does not inherently change the structural inequities and barriers that remain part of the current financial system. As a fintech firm focused on reinventing entrenched industry practices, Blend faces a few critical challenges going forward. One is satisfying increased regulatory scrutiny of lending algorithms to ensure fairness and prevent discrimination. This requires rigorous auditing, as well as culture change within banks to make AI accountability a priority. Another challenge, typical of software companies scaling rapidly, is maintaining reliable customer service and preventing glitches as product complexity increases. Outages or errors could frustrate consumers and hurt their brand reputation. Cybersecurity is also paramount when handling sensitive user data, an area banks already invest heavily. The company must match its security protections to its growing centrality in consumer finance. While demand has surged recently, it remains susceptible to downturns in lending activity that impact its transaction-based pricing model. Economic and industry cyclicality remain risks, especially as this company expands into new volatile sectors like auto lending. Maintaining growth while working to diversify revenue streams is a continual balancing act. Blend ended 2020 on a high note, facilitating over $1.4 trillion in mortgages amid historically low interest rates and the home buying craze. Riding this momentum, the startup raised $300 million in venture funding in early 2021, doubling its valuation to $3.3 billion in just 5 months. However, the company raised $360 million from the IPO, which it used to increase market share, develop new products, and expand into other fintech industries, such as consumer banking. Its stock price has also sunk below $1 billion as of early 2023, down over 80% from its IPO debut in mid-2021. Despite the current mortgage market slowdown, Blend aims to return to growth by aggressively pivoting into broader consumer banking services. With its Blend Builder platform, the company hopes to become the bundling engine for large financial institutions to design and test new digital banking products. If this succeeds, this company believes its addressable market could eventually exceed billions of dollars. Blend's journey has been marked by highs and lows as it seeks to disrupt consumer banking through new technology. Despite early challenges in gaining bank buy-in, its mortgage platform exploded in popularity after 2015. Its partnerships with major lenders fueled exponential growth, validating its strategy. By streamlining lending, this company provides advantages for both banks and consumers. Automation cuts costs for banks while improving customer experiences through faster access to credit. This expands financial inclusion, though Blend must still work within the limitations of partner banks. Looking ahead, Blend aims to rebound from its post-IPO struggles by expanding into new financial services. However, this ambitious pivot faces regulatory, competitive, and economic hurdles. Its founding vision remains inspirational, but its future impact depends on smart execution. If Blend can align technological innovation with evolving industry needs, it may still transform banking for the digital age. But the road ahead will test the durability of its fintech model. Its willingness to adapt while staying true to its mission will define its next act.